So why might we use one method over another of these capital budgeting techniques? Let's talk about it. If we're looking at trying to figure out what's best to use, there are the valuation methods that include time value of money and those that don't. And thinking out loud, you might say, it sounds logical that considering time value of money is probably appropriate to get a better answer. And I would agree with you. Typically, it does. One of the disadvantages of the payback period method, it does ignore the time value of money, but it also ignores profit. It gives you basically a break even. It's at the point of return where you actually are at zero profit. And it ignores cash flows after the payback period. Maybe there's a big influx, or maybe it tapers off or dies down. We don't know because the payback period isn't telling us the whole story. Our accounting rate of return, another non-present value method, would be superior to the payback period method for total life evaluation because it does consider the proposal profitability long term. But again, time value of money is not taken into account. It treats all cash flows equally no matter when they're received. So it says equal period early cash flows are, as you and I know, worth more than later cash flows, but the accounting rate of return does not take that into account. And we have an evaluation of the accounting rate of return here. Both investments receive cash flows earlier. You can see one, it's going to have the same result, but I think you'd agree that you probably want to find the earlier cash flow to be the better option. Then we get to net present value, and this very much is relating to the actual timing of the cash flows. And we see the project, when we're getting the monies, and what the net present value of these two projects is. Yeah, the same dollars come in, but the first project one, positive NPV, net present value of 13,142, and the second one of 6782. So the first one is generating the higher NPV. And then when we look at internal rate of return, NPV does give consideration to the investment size, where internal rate of return does not. And the NPV assumes all net cash inflows are reinvested at the discount rate. And the internal rate of return are investments at the internal rate of return rate. So when we have that 8% and maybe 14%, internal rate of return assumes a higher reinvestment rate associated with that than the NPV, using the rates that we have associated and have calculated. So let's take a look at some of the judgment calls that go into this and some other considerations. So there may not be just a cash flow consideration, even though the four methods we talked about are pretty much cash flow based. What other management input or criteria might be considered? So we look at risk assessment. How risky are these, and how can we hang our hat on these numbers? Are they making sense? The ultimate return to investors. Do we have available resources? Maybe we have fixed sum of dollars and we have 4 or 5 options, and we're trying to make decisions on which ones are the best bet and which ones are the most accurate and best predictor. Other strategic factors might fit our market position. Will it help us complement other products, or would it cannibalize other products? What are our strategies and how are we going to implement? And then what does top management feel about these projects, and how confident are they, and how much effort are they willing to back emotionally and physically to go with that to make it work? Risks are often related to the cost of the initial investment. So we have a starting point and the ultimate time to complete the investment. If you're a senior C-suite member and you're leaving in 2 years, you got a 5-year project, you may or may not be impacted by that retirement or that target departure. Do we need new facilities, and will they operate as planned? What's the life of the facilities, and can we use them for other things as a fallback? How do customers feel about it? What's the impact on our customer base? Operating costs, disposal values, all these things are part of the evaluation and the risk associated. So for risk analysis, we adjust the discount rate for individual projects based on the perception of risk. It's that risk reward thing. Remember, we said chances are you're willing to take a higher risk for a higher reward, or you're more conservative and you are only wanting to take less risk, but are willing to sacrifice some of the reward. Well, this is some of the management perceptions. What are the risks associated? And you're going to compare several internal rate of return and or net present values for a project. And then finally, subject a capital expenditure proposal to sensitivity analysis, how sensitive it is to some of the factors or assumptions that we've made, and we may go way off if some of the assumptions do not track or may not be accurate ultimately. Then we have differential analysis cash flows. Nonprofits typically are not in the same vein as for-profits. Not-for-profits and government entities are providing services, while for-profits are looking to make a profit out of whatever decisions they're making. So we cannot calculate payback period, accounting rate of return on rate of return on some of these projects in the nonprofit world. So sometimes when they have negative net present values in a nonprofit or government world, we may select the least negative value of a present value associated with that. In high-tech investments, those are a little bit trickier as well. Flexible manufacturing systems, computer integrated manufacturing, those are a little bit more touchy-feely sometimes, and you may not have as much of a track record, or you may not be able to accurately project the effectiveness or efficiency because there may not be good examples, because there are new technologies that haven't been proven before or haven't been used before or haven't been applied the same way you intend to apply them based on the capital models you developed. Investing is unnecessary or overly complex equipment. There's a tendency to overestimate cost savings and underestimate incremental sales. So you're saying, well, we're making such a better product. We're going to be much more efficient. Our customers are going to be happy. Hopefully we'll sell more. But again, that's hopeful at this point and may or may not reflect accurately. There's another common error, comparing the costs associated with the current inefficient way of doing things with the predicted cost of performing the identical operation with this modern, efficient, cool equipment. There's a coolness factor that goes in there too. And potential outcome generation of costly, non-value added activities. So we need to be careful when we evaluate and understand these potential errors in our logic and in how we think about things. As I said, we may overestimate the cost savings, base estimates on a single activity cost driver. And again, ABC was that more accurate method of analyzing overhead costs, or forgetting that investments in manufacturing technologies increase rapid, low-cost switching to new products. So we need to factor in, are we going to be changing and what those changes have in store and how these initial projects will affect that. And then we underestimate incremental sales or cost savings, assume the baseline for comparison is the current sales level, which may not be accurate. One other item I do want to talk about is something called the investment tax credit. And the government tries to incentivize companies to invest in certain technologies. They're doing it a lot with the sustainability effects of electronic vehicles, and they're trying to motivate folks by giving a direct credit, a direct write-off off the taxes, not a percentage of that, but a full write-off for investments made in certain technologies, or a percentage of those, but it takes directly off the taxes. So it's a reduction of taxes in the year the new asset is placed in service. Sometimes you can carry forward things. For here in South Carolina, if you invested in solar, you get some carry forward options as well. It reduces your cash outlays for taxes, and that comes into the cash flow analysis, which is why I'm mentioning it here. Treated as a cash inflow for capital budgeting purposes. And then there's something called Section 179 property, allows a full deduction instead of the depreciation. So certain vehicles or certain equipment, in the first year, you can deduct it instead of having to, what GAAP tells you, to depreciate it over 10 years, 20 years, or even 5 years. Section 179 property allows you to deduct it in the current year. So that's some of the additional considerations you want to think about, you want to consider as you're investigating options for capital expenditures. The last module is an appendix, and I'm going to show you some formulas. If you can do the present value analysis with the tables, you may not need it, but for some of you that are into statistics or want to see how the formulas are put together, I'm just adding that last video for informational purposes. And as soon as I say, I'm probably not testing on it, you can disregard it is what you might be doing, but some of you still may be interested. So I'm going to make that available to you if you want to take a look. But you might find it interesting, and it might help actually solidify your understanding of present value and why you use the tables, even though the analysis we're talking about the present value stuff, it has some formulas and some other things that I'll be showing you in that last video. So thank you very much. I will look forward to continuing to be interacting with you and give you some additional insights as we go. See you soon.